Khemani, President and CEO with Edelweiss Securities, joins us. Vikas, uh, is it time to get worried? Earnings are not great. Global cues are not great. Interest rates are likely to rise. I can vouch for the long-term story, which all know that markets will be higher in long term. But in the short term and the medium term, the story, assumptions, and the calculations are getting really sour.
Yes, Nikunj, I think because of the little bit of worsening macros, short term it is looking a little difficult. But at the same time, I do believe that the underlying economic activity is picking up. If you speak to the corporate India today, I mean, whole of last year, most of the corporate India said that we are not seeing markets are bullish, but we are not seeing uptick on the ground. But in last 3-4 months, we've started hearing from across the board from the corporates that activity levels have picked up, things are looking better, and accordingly they are planning. So demand has really picked up. So I do believe that this year is going to be a year of micro improvement where earnings will start looking up, investments will start happening, but at the same time interest rates are going up, which is creating a little bit of worry. We have a bit of political event ahead of us throughout this year. Two big elections are coming, state elections. So I think to some extent these worries are kind of impacting the market mood right now. But having said that, I think market, in my opinion, will consolidate here. This is a nice consolidation. Flows continue to remain very, very strong. Mutual fund flow, if you see, January was reasonably good, 15,000 crore. February seems to be again close to 15-20,000 crores. So I think these flows are giving good amount of comfort. And it's good that market consolidates, for some time in this range as the earnings picks up. So that will basically create good kind of valuations, expected valuation, because earnings will pick up this year, I'm reasonably sure. And if market consolidates here, then you will start seeing even valuation looking quite reasonable. So I think this year will be a little bit volatile, a little bit uncertain, but definitely furthering the bullish bias, definitely creating a base for next level of up move. So you might see 3 to 4 months of kind of consolidation.
Right. Vikas, hi, morning. In the light of what the Fed minutes and our own MPC minutes indicated just yesterday, do you think there is added fear in the market about inflationary concerns going higher and the fact that easy money days are over? Because the Fed minutes clearly indicate that there are going to be 3 hikes by the Fed this year and one perhaps in 2019 as well. They have marked and sounded caution on inflation. And our own MPC minutes as well have stated crude prices, MSP, etc. as being risks to inflation.
So definitely, I think rising interest rates and higher inflation is a kind of worry, and that is what I said, that there are certain macro concerns, and these are the part of those macro concerns. And whenever this happens, I think this kind of events create volatility in the market, that you are seeing one side corporate earnings picking up, you are seeing ground level activity picking up, demand picking up. At the same time, some of the macro factors are working against that. So you will see kind of pull and push on that, and that will create bit of volatile environment. But having said that, we are seeing after long, almost after 7-8 years of hiatus, we are seeing some sort of good economic activity or earnings pick up. And I do believe this is not going to be short-lived. This is going to be sustainable. This is going to be long-lasting. And I think the impact will start showing slowly. So I do believe that this is going to be a year of consolidation. This is going to be the year of where we'll create a solid foundation for where you will probably make much more money in times to come. But given these macro uncertainties, you will see a lot more volatility coming in the market. If any news on the political front can create problem, any news on worsen than expected inflationary numbers can create a problem, any worry on monsoons, market will be very fragile or reactive to those things. So I think all those things, and whenever markets are positioned like this, you will typically see markets are very sensitive to the news flow, and that is what is currently also happening. And I see this kind of characteristics displayed by the market throughout probably this year.
So what would be our out of jail card? What do you think will help the markets revive?
Sorry, Nikun, say it again, please.
No, what will be our out of jail card? What will help the markets revive?
So markets will revive slowly and steadily. I don't have any doubt in my mind. At some level, markets we have flows coming through in the markets sustainably. So I don't see any reason, any reversal of that. And as the earnings start, kind of reflecting quarter after quarter, market will start becoming automatically reasonable if assuming that it remains in a narrow range. So, I don't think, there is any big reason to worry as such from here, but at the same time, it is going to consolidate, it's going to take time. And as corporate earnings revive, you will see markets doing well. Now, it's going to be very difficult to time that how it is going to pan out exactly, but this year is going to be a year of consolidation, in my opinion.
I'm really struggling with any large trends today. You've got one of those days where markets are down, no big fireworks on the downside, and markets are purely now looking to consolidate. Sometimes these boring, dull and dry days are also good, because when markets they start consolidating, they're trying to really make a base. Because where do you think there is still a disconnect between fundamentals and the current market prices? Where do you think that markets still could shave off 10-15% purely because of fundamentals?
See, I think there are definitely pockets of valuations where stocks have got stretched, where demand is going to take time, and maybe wherever interest rate sensitive stocks probably could take some amount of hiatus or some amount of correction. I mean, we already seen financials to some extent that worry being played out, and if let us say it extends, you might see some more it being played out. So in general, those micro-led corrections could happen, but I do see IT as a sector which is going to provide downside to the market. Some of the conventional metals, oil and gas, those kind of commodity players are going to provide a bit of downside to the protection to the market. So I think markets are going to be balanced. I don't see a all wide correction in the market, but there would be pockets which are more macro sensitive, which are more inflation sensitive, interest rate sensitive. You might still see some sort of worry point continuing there. Again, that will a lot depend on how the news flow comes about, how the incremental sort of data points come about. But there is definitely scope in those interest rate sensitive segments to kind of go further down. But again, it is very, very difficult to really call out that what point in time it will and how long it will go on. But it is definitely going to be in narrow range.
So aside of these rate sensitives, Vikas, what else should an investor do at a time when you don't know whether this is going to be a price-wise correction or a time-wise correction that's going to play out in the market, and you do believe it could be an elongated stretch? What else do you do? Do you already start stacking up places where you've made excellent returns all of 2017? Do you partially profit take there? Do you look at new avenues in this dip in the market or correction in the market? What is it that you do?
No, I do believe that this is the time to probably continue to invest if you're not invested, or continue to invest in the long-term trends of the economic, and financialization is definitely long-term trend, and no matter what, whether even if 5% more or 10% more correction is going to come through, which nobody can time out, but they continue to remain a very, very big long-term sustainable story. I do believe that private sector banks, private sector services companies, financial services company across the board, whether it is mutual fund or insurance companies, I think over a long period of time will create great wealth. And if that is the case, then this time is going to be the great time to kind of build exposure. Similarly, I think you could look at huge amount of infrastructure investment is going to happen in this country, right? And lots of money is being spent on that, and there are lots of opportunities around that. Affordable housing is a theme. So around whatever the sustainable trend, and this is going to be a great time. You would not get a lot of stocks in normal course of the time at these valuations, or maybe slightly lower. So you could kind of plan out your investments in those segments and structurally sustainable themes and sectors. I do believe this is going to be, from again long-term portfolio construction perspective, great time to buy. I don't have any doubt in my mind. I don't know whether it will be the bottom will be 5% from here or 7% from here or 3%. That nobody can time out, and that's the reason you have to kind of use this opportunity over the next 3 to 6 months to build out your portfolio across all these themes.
Because the one space which has been shining bright of late has been IT. And again, it's been a very selective move there as well, benefiting from the dollar weakness. What do? Do you look for names which have not really seen an up move? Do you go by an INFI as opposed to a TCS which has already run up? And how do you approach mid-cap IT, which has been relatively a lot better than some of the large caps?
So I think IT sector is likely to do well this year for two reasons. One is I think there is a growth which is coming in from developed markets. Developed market economies are doing very well. The discretionary spend is budgets are opening up, and the IT companies and the industry body has guided for better than historical growth. So I think that clearly shows that there is improvement happening on the demand side, on the volume side. Secondly, I think most of this sector for quite some time has been a very under-owned stock. So in my opinion, now most investors are trying to or looking to get IT stocks in the portfolio as a natural hedge to the currency, because as currency depreciates also it provides some sort of natural hedge in the portfolio. So investors would look to kind of add, and stocks are not very expensive, good quality stocks, high ROE stocks. So I think you will see IT as a sector doing very well. As regard to, I think, mid cap versus large cap, I do believe that mid cap IT would probably give better returns, A, because of the valuation. Secondly, I think some of the mid cap IT companies, and it has to be stock specific, but are better placed to deliver, given their sheer size or base, slightly better than some of the larger players. So A, they have a reasonable valuation and slightly higher growth is possible, and that's the reason you see some of the mid cap IT companies doing very well. But our hypothesis is that companies in general in IT sector will do well this year.
Vikas, let me get closing comments from you. If you had to make a portfolio of 3 NBFCs, and I'm keeping Edelweiss aside because I know you'll not comment on Edelweiss, which are the 3 NBFC businesses you like?
So I think my personal choice, basically from NBFC perspective, I always preferred housing finance as a segment, and I think of late you've seen a lot of correction happening in the housing finance as a segment, and I do believe it has a very, very long legs of growth over the next 5-10 years, given lots of triggers. So I do believe that in that segment, there's a lot of growth ahead of us. Secondly, I think in consumer finance, I do believe that again, given the kind of backbone which has been created, players which are IT driven, which are more technology driven and more consumer facing lending space, I think they will do reasonably well. And thirdly, I do believe that on the banking side, private sector banks which are in general focused for consumer facing or retail lending, where you've seen growth has been coming at more than 20-25%, and they will continue to do well. And given the fact that we have a fairly large portion of the banking sector now not delivering on the credit growth, you will see private sectors capturing that growth very, very well, which are focusing on SME finance, on consumer finance. So I think whether it is NBFC or banking space, this segment of the credit growth I am very, very bullish on. And as the economic growth accelerates, need of capital in this segment will go up. So across retail, consumer retail and SME and housing, these are the 3 sub segments I would look where huge amount of growth is possible over next 5 to 7 years, and even next in a medium term as well.
Vikas, always a pleasure to have you on ET Now. Thank you for joining us, and I certainly look forward to meet you in person when I'm back in Mumbai soon.
Thank you, Nicole. Thanks for having me.
Okay, now